Essential Guide Episode 7 – Applying for Finance. Welcome to the Essential Guide series. Today, we'll discuss applying for business finance with your bank. Approaching your bank for funding means being prepared to answer some critical questions. They'll want to know: what is the exact amount of funding you need and how did you determine this figure? Your personal investment in this request, whether through cash contributions or assets, your current sales and expenses or reasonable sales projections or the guarantee of upcoming work, the repayment term you're aiming for, and how do you plan to meet these obligations. Banks take a holistic approach to assessing your application. They'll examine your financial history, examine your business's past performance, evaluate your realistic financial projections, and consider the macro and microeconomic factors that might impact your business. They'll also align their assessment with their risk appetite and credit policies. Let's explore the types of funding. Short-term funding is designed for immediate cash flow needs and is accessible through facilities like overdrafts, point-of-sale devices, or credit card accounts. Medium-term funding supports the acquisition of operational assets such as machinery or vehicles, typically financed through installment sales or term loans. Long-term funding is generally used for significant investments like purchasing property through mortgage finance. If traditional funding doesn't suit your needs, especially for new businesses in the ideation phase, alternative sources include friends, family, and potential customers on crowdfunding platforms such as Back a Business, angel investors, venture capitalists, or government and private grant and incubation programs. Let's dig deeper into some of the typical bank lending products. Short-term financing. Cash flow is the lifeblood of every business. Here are bank facilities to unlock additional cash flow and free up working capital in your business. Overdrafts. Overdrafts help manage cash flow fluctuations by providing flexible access to funds linked to your current account. Interest is typically paid monthly at a specified rate with annual reviews by the bank. For example, a 10,000 Rand overdraft at 12% interest requires at least 100 Rand in monthly interest payments. It's advisable to discuss personalized rates with your relationship banker. Credit card facilities. Credit card facilities offer a flexible and cost-effective way to manage cash flow and cover daily business expenses. Typically, you can choose to pay the full balance or percentage of the outstanding amount at month-end. Opting to pay only a percentage generally incurs a higher interest rate compared to other credit facilities. If you settle the amount used each month, you avoid interest charges. Remember, paying just the minimum due allows access only to the remaining credit available, not the entire original amount. Did you know that there are some credit card facilities which are interest-free if the total used is paid back within 6 months? Gap Access. Gap Access is an innovative solution from Nedbank if you use a point-of-sale POS merchant card device in your business to receive payments from your customers. You could get a cash advance with flexible repayment terms based on the past sales recorded on your POS device. Repayments occur daily and are paid back as an agreed-upon percentage of your POS transactions over a short period. Debtor finance or invoice discounting. Are you trying to grow your business but all your cash is tied up in your debtor's book? If there is a mismatch between your creditor and debtor terms, invoice discounting will assist you in freeing up the cash tied up in unpaid invoices. All these short-term options can significantly help maintain a healthy cash flow, ensure your business remains operational, and enable growth. Medium-term financing. If you're planning to buy more vehicles or expand your operations, consider using medium-term finance to acquire new vehicles, equipment, or machinery. Often referred to as asset-based finance, this method allows you to use your existing assets and income as collateral to secure loans for new acquisitions. This type of financing is typically available from banks or specialized financial institutions. Repayment terms for asset-based finance are designed to match the specific asset and circumstances of the loan. Common features include paying back both interest and principal, with some agreements also requiring a balloon payment at the end of the term. A balloon payment is a significant final amount needed to finalize the purchase and secure ownership of the asset. These varied repayment options offer flexibility but require careful financial planning to manage effectively. Typically, there are two types of medium-term finance, each with its own agreements. Let's unpack them quickly. Installment sale finance. This financing approach involves paying for an asset over an extended period, with ownership transferring to you only once the total amount is paid off. For example, consider purchasing a car on a 72-month plan. You make monthly payments, and upon completing these, the car becomes officially yours. During the repayment period, this asset is recorded in your business accounting as a long-term asset on your balance sheet, provided it has a useful life exceeding 1 year and costs more than 7,000 Rand. This classification reflects its ongoing value to your business until full ownership is achieved. Lease agreement. With a lease agreement, the financed asset does not appear on your balance sheet, but the cost is included in your income and expenditure statement. Often the asset can be returned to the financier or purchased at the end of the term for an agreed amount. Think about a lease agreement for a property or machinery that you're renting. You can return it at the end of the period or choose to keep it for an additional price. Does this make sense? It's vital to understand how funding affects your business accounting before committing to any financial agreements. Careful consideration is key to managing these impacts effectively. Let's talk about long-term financing for property. Deciding to buy your own business premises is one of the biggest and potentially the most rewarding decisions you can make as a business owner, as it offers stability and likely growth. Commercial property finance from banks will support you on this venture, as it provides a structured path to owning your business location. Many business owners also choose to apply for an ordinary home loan in their personal capacity and use this for their business. This method blends personal and business finances, offering a flexible approach to secure your long-term investment in your business's future. Depreciation and amortization. Did you know that there are some clever and, of course, legal accounting methods that can be used in your medium and long-term funding considerations? Let's look at amortization and depreciation. You've probably heard the term depreciation, and amortization is its sibling. These accounting methods gradually write off the costs of an asset over its useful life. Amortization applies to intangible assets, that is, non-physical assets that add value to a business, such as patents, trademarks, and goodwill. Depreciation, on the other hand, refers to physical assets that also add value to a business, such as buildings and machinery. Any medium or long-term debt repayment involves paying back both the principal amount borrowed and the interest over a designated period. Let's do the math. For example, on a loan of 150,000 Rand with an interest rate of 13% that is repayable over 5 years, a business owner will pay 3,413 Rand per month, excluding admin fees. But the interesting detail about this type of financing is that in 1 month, your repayment of 3,413 Rand covers 1,788 Rand capital and 1,625 Rand interest, while the final payment covers 3,376 Rand capital and 37 Rand interest. There's more to this, but what is important is to understand that as a business owner, the funding option you choose comes with specific tax implications and accounting requirements. Each financing option may be treated differently under tax laws and accounting principles, so it's essential to be well informed about these aspects. Be sure to consult with your banker accountant, or tax professional to select the most advantageous financing options for your business. Their guidance will help ensure that your decisions align with both your financial and strategic goals. Explore the funding pillar on simplybiz.co.za to discover potential funders for your business and craft a compelling pitch deck to impress investors. Unsure about which type of funding is right for you? Don't worry. Our funding wizard is here to guide you through the process, ensuring you find the best financing option tailored to your business needs. Look out for our next episode where we discover the wonderful world of financial ratios and the stories that they can tell you about your business health. Disclaimer: this video offers simplified examples for information only. For a full disclaimer, visit simplybiz.co.za. SimplyBiz, powered by Nedbank, is completely free to all entrepreneurs. Sign up today at simplybiz.co.za.